Welcome back to the channel. I'm Foreman, and this week we're going to be talking about the UK stocks I'm buying right now, including a new addition to the portfolio. Well, my dividend portfolio anyway, and it's about time I've started creating two portfolios. I've got the one core portfolio of growth of a very small handful of stocks. I'm going to create another diversified portfolio of companies that are growing their dividends, and I want to see how the two compare. I have a feeling I'm likely going to get outperformed in my growth portfolio by the dividend one over the medium term, and then we'll see the growth stocks really come to play after the supply chain issues may die down. And if you like the video, please drop one of these to help support the YouTube channel. According to Google Finance, the Ftse 100 is up 1.95%. The Ftse 250 is just ahead, up by 1.99%. And as of recording this video, the S&P 500 is up 1.52%. Bitcoin is also roughly up 4.5% for the week. My portfolio in total is up 2.33%, meaning that yes, I did actually outperform the markets this week, and this is probably the first time in a while. But don't get me wrong, I'm not bothered about that. It's just for entertainment purposes to see how it racks up on the short term, because ultimately I'm invested for the longer term, and even if I'm consistently underperforming for the next 2-3 years, I believe that there will be one good year in the future that will certainly recover those returns and really big up that CAGR, or Portfolio Compound Annual Growth Rate. And this week we've got some interesting news. If we look at the screen, we've actually had the ASOS boss leave. The CEO of ASOS has actually left the role, and he'd been with ASOS for 12 years, including 6 as CEO. So obviously this makes sense. This is usually the average tenure of a company or of an executive in a company, and so it makes sense. What was quite interesting is that obviously the CEO leaving isn't a great look, and they didn't find a replacement CEO. Usually when you're going to leave, you're going to line up someone else to take your spot. But then there were also some director buys, which is very interesting at least. And in fact, there's more towards ASOS, because the ASOS has likely been saying that their performance is likely going to be strained by demand volatility in global supply chain and cost pressures. This goes to highlight that the fast fashion, even fashion industry as a whole, is very much struggling right now. This is an industry that obviously the online retailers are certainly in an advantaged position, but because ASOS sells other brands as well, it's certainly at a little bit of an issue. And this is partly why, or one of the reasons why I'm invested in Boohoo. They sell their own brands, they've got higher margins on that, and they do also create some of their products in the UK, meaning that they can adhere to the demand in the UK. Sure, obviously they're going to get some other stuff shipped over, but with their test and repeat business model, I think Boohoo is certainly in a good spot. And I think that this whole problems at the moment with the freighting costs, the shipping costs, we're seeing air travel start to return to normal. So we may see shipping costs start to lower as perhaps air traffic, for instance, or air trade become more popular. We may see freighting decrease in price. I think Boohoo is set. In fact, this is the short to medium term, and I think this is just a medium term problem. And right now, Boohoo is a steal in terms of price. And that's why I've bought an additional 423 shares. I'm desperately trying to get to that 5,000 share mark, because every time Boohoo rises by 1 pence, that's £50 right there that have been made. And shout out to Stephen, because he had mentioned this. He said that I should aim for 10,000 shares, because then it'd be at £100 per 1 pence that a share increases. Obviously, it's not as easy and sustainable as that, but obviously it's a cool way to look at holding your shares. We've also got the likes of actually Debenhams marketplace launching. So back to the screen, and what they've interestingly noted is that they're creating a Debenhams beauty store in Manchester. Forget the whole retail store, although I have mentioned this in the past and I thought this is a good idea. You have 1 or 2 stores in big popular locations, and what it'll mainly do is serve as an expensive marketing campaign, where effectively the whole point of your store being there isn't for the sake of making high earnings. In fact, you could have very low margins, but if it makes people aware of your brand, and for instance, if the prices are competitive, people are going to go there. And so it's only increasing your brand awareness. But something I mentioned before as well is that when Boohoo acquired Debenhams, unlike ASOS acquiring Topshop, that they were looking for diversification. Not only were they looking for diversification in their age demographic, what we're actually seeing as well is that they're going to be selling the core things that Debenhams sold, such as beauty, homeware, obviously fashion, and amongst other things. And it's great because this is the diversification I was looking for. If they see success with Debenhams, obviously they can expand out their beauty sector and they can put it into other brands like Pretty Little Thing and Boohoo themselves. And this obviously is going to expand and expand, and as growth continues, it's going to be strong. And obviously they were saying the demand is coming back, and I'm confident that they are right on that. And to see shares like dropping by such an extreme amount, I'm obviously going to be averaging down. Hence why now my average share price is £2.41, which is down from £2.47 last week. Shares are up 2.69 for this week. And when shares in Boohoo had dropped earlier on and they dropped below my average price, I didn't panic. Instead, I had a plan. I had a plan because of one of my books that I've been reading, The Art of Execution by Lee Freeman Shaw. Basically, it highlights, and this is this gentleman suggested to the fund managers that obviously he was looking or responsible for, he suggested that when a stock drops by 20%, that you should consider the position. Don't forget about it, don't leave it in the background, but focus on it. Are you going to buy more? Are you going to substantially buy more shares and lower the average price? Are you going to cut your losses? Or are you going to sit? Sitting and holding is usually the bad choice because you don't really benefit from the dip, and neither do you benefit if it drops further. But obviously, if you cut your losses, it could drop further and you've saved yourself a lot of pain. If the story is certainly changed, then that could be the option. But the idea here is that millions of people, not millions, that some of the world's greatest investors lost a majority of the time on their trade ideas, but they still made millions. So if you're interested in The Art of Execution, I'm going to leave a link in the description down below. It's certainly my favorite read so far of 2021. Games Workshop has been my top riser this week, with shares gaining 5.88%. There isn't really any news in this part, but I think it's part of the recovery because obviously their shares have dropped by about 20% in the last month, and so it's a bit natural for shares to start recovering a little bit. We were seeing price expansion multiples being squeezed a bit, and now we might see it increase a little bit more. Obviously this is just short to medium term volatility, but they certainly had their concerns with the shipping costs and the freighting being so expensive. Again, another industry where a company is struggling, believe it or not, there's a majority, and I think this is going to impact a lot more stocks than you believe, even if they aren't directly shipping to consumers. Even if they're perhaps a tech-only software as a service business, they may be impacted by the other businesses that aren't generating as much revenue and therefore aren't using their software as a service as much, or even staying subscribed. So we could see quite a collateral setback towards the global economy if these freighting issues are not addressed and if they do not improve. Obviously, we may see some issues coming up to the Christmas period. If people start panic buying again, obviously we know what's going to happen then, and it's going to go bad. So not only have we made it past the pandemic, or at least for the most part, now we've got to deal with issues with supply chains, which is something that I've got to get used to at this point, as Boohoo and their ESG last year, obviously it wasn't that great. And so this week I actually bought 2 more shares of Games Workshop. I bought whilst they were below £100 per share. I'm just slowly averaging up on my position. I'm very bullish on this stock in the long term, and I feel that they do have, whilst they have cut their dividend, that they will be doing quite well. And if you'd like to sign up to my stockbroker Freetrade, you can actually get a free share worth up to £200 when you use my link in the description down below. So don't forget to sign up to get that free share. Algo Blockchain has dropped by 0.32%, but we've seen Bitcoin climb quite strong this week. I've personally created my updates and my opinions on Algo Blockchain. I've spoke about a few things. 2 things I forgot to mention in my stock analysis, I'll put the card at the top right of the video, is that for the Algo Blockchain, in the last month, September mining update, they only mined roughly 160 Bitcoin. When they have 1.07 exahash of mining power, they should really be mining more than that. So I have a belief that perhaps they are trying to turn on the machines at the best possible time in order to benefit their margins. They're trying to improve their unique selling point by perhaps only having machines on the most efficient times. This could be a negative because if you believe in the long-term growth of Bitcoin, this may be a concern because you just want them to accumulate more, right? But then if this counters out the depreciation of the machines, which I'm not sure if it does, then perhaps the costs balance out. But it really depends on how much lower the margins would really go if they did have them running full stop. And the other thing I didn't mention was due to their credit facility. I mentioned that we may be due a few share dilutions. Obviously at the moment the cash position from the NASDAQ listing is certainly protecting us, but they did say they had access to that $100 million credit facility due to their Texas location. they've not used that, and instead they've taken up more aggressive loans since. Perhaps obviously the interest rate is a bit higher than the other ones, and so they've had no need to, and they're trying to keep it in the back line, or perhaps there's something misleading about it. But that's my thoughts on Argo Blockchain that I didn't add in the stock analysis. It's, once again, if you're interested, card at the top right of the video. I still hold 4,001 shares. Currently, right now, I'm trying to buy other holdings. But, for instance, if my main holdings do recover in share price, then I will be looking at Argo Blockchain just to chip away and lower that average price. I also sold 100 shares of Team 17 this week. I did this to fund my acquisitions of Games Workshop and Boohoo. I mentioned this last week, so I will be brief. Selling Team 17 because they both compete for your time. Games Workshop, Team 17. They're both entertainment companies, and effectively they're in very similar niches. Whilst obviously they are different and are diversified and have their own margins, is that Team 17 is a software video game developer and Games Workshop is a miniature figure retailer. Games Workshop has their royalties that they loan out to video game developers, and the issue here could be that obviously they're going to be competing in very similar niches. I might as well put the capital into one that I have the highest conviction with, which is Games Workshop. I know obviously I've been very bullish on Team 17 and I still am. It's just at the moment I feel that Games Workshop is certainly the better value investment, and I think that's the one I've really got to stick with and just have a smaller consolidated portfolio of stocks that I really truly believe in. Otherwise I'm not going to be able to get enough capital in these investments, and I may not benefit as much when we see the recovery of these stocks. And then last week I mentioned I was creating a dividend portfolio. I've started that creation this week and I've created a SIP with Freetrade. It costs £7 a month, and honestly I'm not going to be depositing that much, but oh well, right? Because at the end of the day this is an investment in the content of the channel. The stock I actually bought this week was Dunham Group, and they've had a pretty strong trading update. In fact, they had seen that the total sales in the quarter had increased by 8.3% compared to the full year of 2021. That's very impressive, but they've also got a net cash position of over £200 million. I think they're good diversification. I don't really have a retailer that could easily be competed with. So obviously I've got Boohoo. They don't really have a moat. There are other companies who come in, undercut the prices if they can afford it, and that puts Boohoo at a disadvantage. Games Workshop, there could be the rise of 3D printing. 3D printing could certainly be a concern for the company, and so they can be competed with. It's not hard to then ship those products. Even could be done on Amazon, for example. Whereas Dunham Group is quite interesting because a lot of the items they sell are bulkier, they're bigger. This makes shipping more inconvenient, and I feel there is a purpose for the retail stores. Don't get me wrong, they also have an online segment too, which is always a good thing, but I think that this is a great way of getting diversification. I'd like some bricks and mortar. Yes, Games Workshop has their stores, I'm completely aware of that, but for a dividend stock, I think I quite like it. The yield is roughly around 3%, and shares have dropped quite a bit in the last month or so, as they've seen the pullback due to the supply chain logistic issues, and I think that Dunham could be a good addition. I did look at the dividend history, and yes, they had obviously cut their dividend, or suspended it in 2020, and that was due to the pandemic issues. Realistically, a lot of companies had done this. A lot of them that were uncertain on the overall market environment had done so. Obviously, you might go, yeah, well, I want a company that grows my dividend every single year, but at least they've recovered it. So it could just be that one-off year where they've went, okay, no, we're not going to pay a dividend, we're going to leave it for now. And I think that was a good thing. That was a wise move by the management, so they have truly surplus capital available if they needed it in the business. On the plus side as well, I believe their payout ratio is fairly low. I believe it is around about 50%, which means they've got a lot of room to grow their dividend, but as well as grow the business. Dunham Group is the first of a few companies that I've been buying. I've only got 3 shares. Obviously, this is going to be a very small portfolio, but I do hope you find this whole interesting bit so that the whole separate portfolio of dividend stocks could provide some interest to you when you're watching the channel. And if you'd like to see my Argo blockchain stock analysis, then click the card at the top right of the video. Thank you for watching. Have a fantastic week.